Namaste and welcome to Fintamin. I am your financial guide for this course. Today we begin course 1, that is Stock Markets 101. This course is designed specifically for working professionals like you, people who have heard about the stock market, maybe even invested a little, but want to truly understand how it works from the ground up. So, in the next 8 modules, we will cover everything from what the Bombay Stock Market Exchange actually is, to how you open a demat account, to reading your first stock chart, and finally making your first real investment with confidence. This is not theory. Everything you learn here, you can apply the same week. So, let us begin. Before we dive in, let me give you a map of where we are going. Module 1 covers financial markets. In that, we cover what is BSE, NSE, Sensex, Nifty, etc. Module 2, we cover stocks and shares. What you actually own when you buy a share. Module 3 is the demat account, how to open one step by step. Module 4 and 5 cover reading stock quotes and fundamental analysis, the basics of valuing a company. Module 6 introduces technical analysis of how to read a price chart. Module 7 is risk management, the most important module for every investor. And Module 8 is your action plan, your first real investment. Each module builds on the previous one. So if you are watching this for the first time, I recommend going through in order. Let us start with module 1. Module 1 is financial markets. In this module, we answer one simple question. What is a market? And specifically, what is a financial market? Think of a financial market as a bazaar. Just like your local vegetable markets, where buyers and sellers meet to trade vegetables, a financial market is where buyers and sellers meet to trade financial assets. Now, there are four main types. The stock market or share bazaar is where you buy and sell ownerships in companies. The bond market is where governments and companies borrow money. The commodity market trades gold, silver, oil, and agricultural products. And the foreign exchange market trades currencies, dollars, euros, rupees, etc. As an investor in India, you will primarily deal with the stock market. This is our focus in this course. And here is the most important thing to understand, that a market creates what we call price discovery. The price of any share is simply what millions of buyers and sellers agree it is worth. In real time, there is no committee deciding the prices. It is the pure demand and supply. India has two main stock exchanges. The Bombay Stock Exchange, BSE, was founded in 1875. It is Asia's oldest stock exchange. Over 5,500 companies are listed here, and its benchmark index is the Sensex. The National Stock Exchange, NSE, was founded in 1992. It is more modern and technology driven. About 2,000 companies are listed, and its benchmark is the Nifty 50. NSE has the highest futures and options trading volume in the entire world. Now, the important thing. Both exchanges are regulated by SEBI, the Securities and Exchange Board of India. Think of SEBI as the traffic police of financial markets. And when you open a broker account, you can trade on both BSE and NSE from the same account. Let us move forward to Sensex and Nifty. You hear Sensex and Nifty on the news every single day. But what are they actually? An index or Suchkank is like a thermometer for the market. Just like a thermometer tells you the temperature of your body, Sensex tells you the health of the top 30 companies of BSE, and Nifty tells you the health of top 50 companies on NSE. The Sensex started at 100 points in 1979. In 2024, it crossed 75,000. That is the power of long-term investing in the Indian company. Here is the simplest way to understand it. If Nifty rises 1% today, on average, the 50 biggest Indian companies gained 1% in value. That is it. When you hear market is up 200 points today, it means Nifty moved up 200 points. Who is actually buying and selling in these markets? Let me introduce you to the key players. First are retail investors, that is you and me, individual people investing their savings. Second, mutual funds and insurance companies. They pool money from lakhs of investors and deploy it in the markets. Third are FIIs, which is foreign institutional investors. Global banks and hedge funds from America, Singapore, Europe. When FIIs buy India, markets go up. When they sell, markets fall. There are also banks, insurance companies like LIC and algorithmic traders, computer programs that execute trades in milliseconds. Algorithmic traders account for over 60% of NSE's daily volume. As a retail investor, understanding what the big players are doing gives you a massive edge. We will learn more about tracking institutional money in the advanced course. Let me show you what happens in the 3 seconds between you tapping buy on an app and trade being confirmed. Step 1. You place an order at Zerodha or Grow. Step 2. Your broker validates the order and checks your funds. Step 3. NSE's order matching engine matches your buy order with someone who wants to sell at the same price. Step 4 is the trade is confirmed in microseconds. Step 5. The shares arrive in your demat account the next business day. This is called T plus 1 settlement. The entire process from your tap to trade confirmation takes under 3 seconds. India's exchange infrastructure is world class. Stock markets in India are open Monday to Friday. There are no trades on Saturdays, Sundays, or national holidays. The pre-open session runs from 9 to 9:15 a.m. This is when orders are collected and the opening price is determined. The main market session is 9:15 a.m. to 3:30 p.m. This is when all trading happens. After 3:30, you can place aftermarket orders for the next day. One important thing to remember, 9:15 a.m. to 3:30 p.m., that is your window, and you have approximately 22 trading days per month. Let us move to module 2, that is stock and shares. Stocks and shares. What do you actually own when you buy a share? Let us find out. What is a share? Imagine Tata Motors has a total value of 2 lakh crore rupees. Now imagine this value is divided 200 crore equal pieces. Each piece is one share or one hissa maybe. If you buy 100 shares of Tata Motors, you literally own a tiny fraction of the company. You are a part owner. This means 4 things. 1. If the company profits, your share price rises. Second, the company may pay you dividends from its profits. Third, you get voting rights in the company's annual general meeting. Fourth, if the company shuts down, you have a claim on its remaining assets. This is fundamentally different from keeping money in a bank. In a bank, you are deposited; in a company, as a shareholder, you are an owner. Not all companies are the same size. We classify them by market capitalization or Bazar Punjikaran. The formula is simple. Market cap equals share price multiplied by total number of shares. Large cap companies have a market cap above 20,000 crore rupees. Think of Reliance, TCS, HDFC Bank, Infosys, etc. These are stable, well established businesses, lower risks and moderate return. Mid cap is between 5,000 and 20,000 crore, higher growth potential but more volatility. Small cap is below 5,000 crore, high risk but can give spectacular returns if you pick the right companies. My recommendation for beginners: start with large cap, add mid cap after 2 years of experience, small cap only after deep research and long time horizon. There are two main types of shares. Equity shares or Sadharan shares are what you trade on NSE and BSE. Full voting rights, no guaranteed dividend, higher risks, and higher return potential. Preference shares gives you a fixed dividend, like a hybrid between a share and a bond, but they usually have no voting rights and are mostly held by institutions, not retail investors. As a retail investor in India, you will almost exclusively deal with equity shares. This is what we mean when we say buying a stock. Why do share prices move? This is one of the most common questions I get. Why does a stock price go up or down? The answer is pure demand and supply. Price rises when more people want to buy than sell. Price falls when more people want to sell than buy. Everything else like earning results, RBI rates, FII flows, news, etc., it all works by changing demand and supply. Company factors like strong quarterly results, new contracts, or good management increases demand. Macro factors like RBI rate cuts or FII buying increase demand market-wide. Sentiment factors like good media coverage or analyst upgrade can temporarily boost demand. Here is the most important insight. Short-term prices follow news and sentiment. Long-term prices follow the fundamental strength of the business. This is why patient investors always win. Companies in the stock market are grouped into sectors or kshetra. IT companies like TCS, Infosys, Wipro are in the technology sector. HDFC Bank, ICICI, Bajaj Finance are in banking and finance. HUL, ITC, Nestle are in FMCG, fast moving consumer goods. Why does this matter? Because different sectors perform differently at different times. IT does well when interest rates fall globally. Banking booms when the economy is expanding. FMCG is defensive. People buy soap and biscuits even in recessions. Diversifying across 3 to 4 sectors is one of the most basic risk management strategies you can use as an investor. Now that you know what stocks are, let us talk about how to actually buy them. That is Module 3, the Demat account. Module number 3, the Demat account. Before 1996, shares were physically paper certificates. You could lose them, they could get damaged, etc. The Demat account changed all of that. Let me show you how. What is a Demat account? A Demat account, short for dematerialized account, is your digital locker for shares. Just like your bank account holds your money electronically, a Demat account holds your shares electronically. To invest in stocks, you actually need three accounts working together: a Demat account, which holds your shares, a trading account, which you use to place buy and sell orders, and your regular bank account, which funds your trades. Most modern brokers open all three simultaneously in one seamless process. You open one account and get all three. Here is something most retail investors do not know. Your broker does not actually hold your shares. Two government regulated depositories do: CDSL and NSDL. CDSL means Central Depository Services Limited. It's promoted by BSE and works with brokers like Zerodha and Grow. NSDL means National Securities Depository Limited, is India's first depository promoted by NSE and works with HDFC Securities and ICICI Direct. This means even if your broker goes bankrupt, your shares are completely safe. They are held by CDSL or NSDL, not the broker. This is a critical safety feature of Indian market system. Choosing your broker. A broker Choosing a broker. A broker is your gateway to the stock exchange. There are two types: discount brokers and full service brokers. Discount brokers like Zerodha and Grow charge a flat fee, typically 20 rupees per trade, regardless of the size. Account opening is free. The platforms are excellent. I recommend these for most investors. Full service brokers like HDFC Securities or ICICI Direct charge high brokerage, around 0.5% per trade, but offer research, advice, and relationship managers. Better suited for investors who want hand holding. For most of you watching this, my recommendation is simple. Open a Zerodha or Grow account, free to open, flat 20 rupees brokerage, SEBI registered, excellent mobile apps. You can be investing within 24 hours. Documents required. To open a Demat account, you need four things: PAN card, this is mandatory for all investments in India. Aadhaar card for eKYC. Your Aadhaar card must be linked to your mobile number for OTP verification. A recent photograph or selfie, and your bank account details, either a cancelled check or a bank statement. That is it. PAN, Aadhaar, selfie, and bank details. The entire process happens on your phone. No physical documents, no branch visits required. Opening your account in 6 steps. Here is exactly how to open your account. Step 1, download the Zerodha Kite or Grow app and click Open Account. Step 2 is register with your mobile number and verify via OTP. Step 3 is enter your PAN details and complete eKYC using your Aadhaar mobile OTP. Step 4 is upload your cancelled check or enter your bank details. Step 5. Click a selfie or complete the 2-minute video KYC. Step 6. E-sign and submit. Total time required is 15 to 20 minutes. Your account is usually activated within 24 hours, and your first investment can be as small as 1 rupee on some platforms. I want you to pause this video right now. Open the app and start this process. Do not wait. The account takes 24 hours to activate. So the sooner you start, the sooner you can invest. Once your account is open, you will see stock prices everywhere. Let us learn how to read them. Module 4 is reading stock codes. Reading stock codes. When you open any stock trading app, you see numbers everywhere. Let me decode every single one of them. Anatomy of stock code. Look at any stock on NSE or your broker app. Here are the 6 numbers you must understand. First one is LTP, which is last traded price. This is the price for most recent transaction. When people say what is the price of Reliance today, they mean LTP. Second is open and close. The open is the first trade price of the day. Close is the average of last 30 minutes of trading, not the last price. This is actually more meaningful than most people think. Third is 52-week high and low. This tells you the highest and lowest price the stock has traded at in the last 1 year. This is your context for whether the stock looks cheap or expensive. Fourth is the volume, the number of shares traded today. High volume plus price rise is equally a strong signal. Low volume plus price rise, be cautious. The move may not sustain. Fifth is the market cap, price multiplied by total shares. This is how you classify the company as large, mid, or small cap. Sixth is the PE ratio, price divided by earnings per share. The most important valuation metric. We covered this in detail in Module 5. Reading candlestick charts. Every stock has a price chart. The most common type is the candlestick chart or Mombatti chart. Each candle represents one time period. Could be 1 minute, 15 minutes, 1 day, or 1 week. Each candle shows 4 prices: the open, high, low, and close. The body of the candle, the thick part, is between open and close. The thin lines above and below are called wicks. The green candle means close was higher than open. Buyers won that period, price went up. A red candle means close was lower than the open. Sellers won, price went down. Here is the most important insight about wicks. A long lower wick means sellers pushed price down hard, but buyers came in and brought it back up. That is a bullish signal at support. A long upper wick means buyers tried to push higher, but sellers rejected the price. That is a bearish signal at resistance. Do not worry if this seems complex right now. Practice for 10 minutes a day on any charting app, and within 2 weeks, you will read candles like second nature. Now that you can read the price, let us learn to value the business behind it. Module number 5 is Fundamental Analysis. Fundamental analysis. This is how you answer the question: is this company worth investing in? Is it financially healthy? Is it a stock price fair? Five key fundamental ratios. Fundamental analysis means studying a company's financials to decide if it is good investment or not. Let me give you 5 key ratios that every investor must know. Number 1 is EPS or earning per share. This is net profit divided by total shares. It tells you how much profit the company made per share. A company with growing EPS year after year is a growing company. Simple and powerful. Number two, PE ratio or price to earnings ratio. Share price divided by EPS. This answers how much am I paying for 1 rupee of the company's earning. A PE of 20 means you are paying 20 rupees for every 1 rupee of earning. Lower PE compared to industry average means cheaper valuation, but always compare within the same industry. IT companies naturally have higher PE than banking companies. Number three is ROE, return on equity. Net profit divided by shareholders' equity multiplied by 100. This tells you how efficiently management is using your money. Above 15% consistently is a sign of well-run business. Number 4. Debt to equity ratio. Total debt divided by total equity. How much has the company borrowed versus what it owns? Below 1 is generally safe. Above 2 is risky. The company is heavily leveraged. Number 5, ROCE, return on capital employed. Overall business efficiency. Above 15% and growing consistently means excellent capital allocation by management. My shortcut for beginners. Find companies with PE below industry average, ROE above 15%, and debt to equity below 1. That is your starting filter. Screener.in is a free tool where all these ratios are available for every listed company in India for you all to refer and start. Module 6, a brief introduction to technical analysis. We have a full dedicated course on this. Course 3, but let me give you the two most important concepts right now. The two main important concepts in technical analysis are support and resistance. Support or Samarthan star is a price level where the stock has bounced upward multiple times. Buyers keep stepping in at this level because they see it as good value. Think of it as a price floor. Resistance or Pratirodh star is a price level where the stock has repeatedly failed to go higher. Sellers appear at this level, booking profits. Think of it as a price ceiling. Here is an example. If Reliance has bounced off 2,400 rupees three times in the last 6 months, that is strong support. Every time it comes near 2,400, buyers have appeared. If you want to buy Reliance, waiting for it to come near 2,400 gives you a better entry than buying it at 2,600. And here is the most powerful concept. When resistance is broken with high volume, it becomes the new support. This is called a breakout, one of the most reliable signals in all of stock market analysis. Let us move forward to module number 7, that is risk management. I will be honest with you. This is the most important model in the entire course. Most people who lose money in the markets do not lose because they picked bad stocks. They lose because they had no risk management. There are 5 golden rules of risk management. 5 rules, learn them, live them. Rule number 1 is never risk more than 2% of your total capital on a single trade. If you have 1 lakh rupees, risk a maximum of 2000 on any one position. Even 10 consecutive losses only takes you down 20%. You survive, you learn, you come back. Rule number 2. Always use a stop loss. Decide your exit price before you enter the trade. If the stock hits that level, you exit. No discussion, no hoping. The moment you start hoping in the stock market, you have lost. Rule number 3. Diversify across 10 to 15 stocks and 3 to 4 sectors. If one stock crashes 50%, your portfolio losses only 3 to 5%. Diversification is your shield. Rule number 4. Never invest borrowed money. No loans, no credit card debts, no breaking your fixed deposit for stock investment. Only invest money that you can afford to lose 100% of without affecting your life. Rule number 5. Only invest in what you understand. If you cannot explain a company's business in 2 sentences, do not invest in it. Research first, invest second. Print these 5 rules. Keep them where you can see them every day. Every successful investor I know who is profitable today follows these rules religiously. Let us move to the next module, your first investment, the final module, and the most actionable one. Let us turn everything you have learned into a step by step plan for your first real investment. Here is your action plan starting this week. Open your Demat account on Zerodha or Grow. Fund it with 5,000 to 10,000 rupees just to start. The amount does not matter as much as the habit. In week 2, research 3 companies whose products you use every day. HUL, you use their soap. TCS, you know their reputation. HDFC Bank, you may even have an account with them. Check their PE ratio, ROE, and whether the stock is above or below its 52-week average. Also in week 2, start a SIP of 2000 rupees per month in a Nifty 50 index fund. This is the single best investment for any beginner. Automatically diversified across 50 companies. Extremely low cost. Just 0.1% ratio expense ratio. Set it and forget it. In week 3, make your first direct stock purchase, even one share, even if it is worth only 500 rupees. The act of placing your first real buy order and watching it execute will teach you more than 10 hours of theory. From month 2 onwards, check your portfolio once a week, not every day. Read the quarterly results of your companies you own. Notice what moves the stock. You are learning as a part owner now, not as a spectator. Remember what I said at the beginning. The best time to start investing was 10 years ago. The second best time is today. Do not wait for the right time. The right time is always now. Congratulations, you have just completed Stock Markets 101, Course 1 of the Fintamin Financial Education series. Let me quickly recap to what you know now. First is financial markets. We learned what BSE, NSE, Sensex, and Nifty are and how a trade executes. Second, we learned what stocks and shares. What you own when you buy a share, the different types, and why prices moves. Third was Demat account, how to open one, which broker to choose, and the KYC process. Fourth was reading stock quotes, every number on stock page and how to read a candlestick chart. Then we learned fundamental analysis. The 5 ratios that tells you if a company is worth investing in. Next we learned was technical analysis, the basic of support and resistance. Next was risk management, the 5 non-negotiable rules that protects your capital and your first investment action plan. The next step is clear. Open your Demat account today if you have not already. Start your SIP when you are ready to go deeper. Course 2 is Mutual Funds Masterclass. Course 3 is Technical Analysis and Course 4 is Futures and Option Foundations. I am your financial guide from Pentamin. Our mission is to democratize financial planning for every working professional in India. If you have questions, reach us at fintamincare@gmail.com or WhatsApp us at 9860148848. Thank you for investing in yourself. That is always the highest returning investment you will ever make. See you in course 2.